As we near 2025, our guest says investors should be underweight the US, especially large cap mega tech companies. Let's get more from Gavin Graham, Chief Investment Officer and Portfolio Manager at Spire Wealth Management. Gavin, always great to see you. You feel there's too much euphoria in US stocks right now, broadly speaking?
Yes, and Andrew, thanks very much for having me as always. You're done so well. You know, it's not merely one really good year, and we're up the best part of 27% for the NASDAQ, and a lot more if you're in the mega tech names. But that comes on top of a really strong year in 2023. How much better does it get? Now, if you were to believe the general crowd view at the moment, things can only get better, to use that song they used when Tony Blair was getting elected 25 years ago. One has to feel that is probably being too optimistic, because we are, and I think we had this discussion last time, Andy, but this is one of the three most expensive US stock markets in the last century. The two previous ones, when the stock market as a percentage of GDP, stock market capitalization, was this high, were 1929 and 2000, which was the end of the tech bubble. Wow. And realistically, when you're at this level of valuation, I won't call it overvaluation, because unlike, say, 2000, you do have a lot of really strong earnings growth from these companies, but they're still really, really expensive, even with that strong earnings growth. The average annual return has been low single digits, 1 to 3% a year. And that's if the earnings growth keeps coming through. And realistically, it's hard to see these large cap mega techs being left alone. We've just had the Chinese starting to go after Nvidia. You're talking about making Google give up some of its operations. The EU is always going after one or other of these. It's very difficult to see things getting any better for where they are now. Whereas markets, for example, smaller caps in the US, or particularly Canada, which doesn't, as we know, have a big tech sector, but has a lot of quite good quality companies with good earnings, look more attractive.
What do you make of the fact that gold has soared this year, up around 30%, despite strength in the US dollar, certainly in recent months?
No, I mean, again, people try to link gold with the real rate of interest, or with the US dollar, or with geopolitical uncertainty. I think most people would agree, who've been following it for a few years, that gold is essentially portfolio insurance. It's not particularly correlated with anything. It's nobody's liability. It has retained its value over a couple of thousand years. The big thing, I think, driving it this year, Andy, has been foreign central banks buying it. And the Bank of China has just actually come out and said it's going to buy a lot more. And you think, well, why are you saying that now? Well, perhaps because you already bought a lot, but it seems that foreign central banks have bought more gold in the last 2 years than the whole previous 6 years put together, partially driven perhaps because of the US suspending Russia from the SWIFT international banking system when they invaded Ukraine. And it's made foreign central banks think we need our assets, at least some of our assets, in something that cannot be switched off at another country's whim, as it were. But we haven't really seen the Western retail investor get into gold yet. They've all been chasing large cap megatech stuff. The actual number of ounces in the GLD, the gold ETF that holds a tenth of an ounce of gold, is lower than it was back in 2000 when gold, 2020, when gold first went over $2,000 an ounce. So if investors actually say, maybe we ought to have some of this asset, because guess what, Andy? Guess what's the best performing asset this year? It's not NASDAQ, it's gold.
You think America just overdid it with its sanctions on Ukraine? They should have realized that other countries would see this as a power grab?
Sanctions on Russia for invading Ukraine, absolutely. Yeah. No. And indeed, you recall the same thing happening with Iranian assets after the mullahs overthrew the Shah. Their assets ended up being frozen, and it took a large number of court cases and many years to actually get that sorted out. What's that old line? You don't want to be dependent on the kindness of strangers. And if you're using a banking system that's regulated by the US, and the US decides it doesn't like you, for good and sufficient reason in many cases, then they can switch off your access to it.
You got in the Tennessee Williams reference there. You have a couple of stock ideas. You're staying with us very kindly for 2 blocks, Gavin. But before we go, one name you like in renewable power is Northland, a huge participant in the wind power sector in Europe.
Yeah. Absolutely. And obviously, one of the difficulties with wind is sometimes it blows more, sometimes it blows less. But Northland's down about 50% from where it was at the peak of the green revolution enthusiasm 2-3 years back when President Biden was putting loads of money into it. And it has 2 really big offshore wind platforms coming on, one off Taiwan, which may not necessarily be the best geopolitically, but the other one is off Poland in the Baltic, which, especially if there is some resolution coming in Ukraine. But either of them, it's all completely funded. There's no recourse to Northland. And in the meantime, you get a 4% yield while its existing wind power assets continue to churn out pretty reliable cash flow.
But sorry, why is the stock down so much, Gavin, in the past year?
In the past couple of years, well, it's a couple of things. Boralex, which is another recommendation, Interjects, they're all off something like 50% since the end of 21, beginning of 2022. Because you remember, the US government was throwing loads and loads of money at the green revolution, and we're going to spend on all the infrastructure. And the prices got very ahead of themselves. We actually recommended one of the investment letters I write for. We recommended taking a profit on Boralex at the end of 21 because it had doubled, and it's still well below where it was, although up from where we originally recommended it. Again, the price you pay for something takes the return you get.
You have another idea in real estate. Killam Properties, a player in the rental market.
It is, and it's the major player in Atlantic Canada. And again, that's been an area lots of people have moved to during COVID. It's much more reasonably priced. But interestingly, Killam has actually been expanding into Ontario, particularly southwestern Ontario, outside the GTA. Something like 25-30% of its units are now in Ontario, and it's looking at a target of 40%, while selling some of its units in smaller markets like Prince Edward Island. And in the meantime, again, you get a good 4.5 yield.
You have another idea in asset management, Guardian Capital. What attracts you there, Gavin?
Well, it's my former employer from 20 years ago, but I should say sentiment is not merely the reason. It's been one of the really big success stories. It's one of the half dozen biggest Canadian independent asset managers, and they've just done a really big transformative deal buying off Truist, a major asset management firm in North Carolina, which has more than doubled the size of its assets under management. I think they're looking at something like 150 billion now, up from 50 billion. Pays a steadily increasing dividend. No, by the way, they still have a couple of million odd BMO shares they got when they sold the mutual fund business to BMO 20 odd years ago, and that's not really reflected in the price.
And you have an idea in gold mining. It is a name that's done very well. Alamos Gold, among other things, they have a super profitable mine in Ontario.
They have, and they just bought another one, which is right next door to it from Argonaut, which was cash-strapped because they didn't have enough funds to actually fully develop it, but it's literally just across the lake if you look at the pictures, and they can use the mill there, which is one of the reasons Argonaut had to sell, to put the gold from its own mine plus Argonaut's mine through it. So it's now probably, I forget, the 3rd or 4th largest gold miner in Canada. The price has done very well, but if there were to be a takeover of gold assets in a politically stable jurisdiction where military juntas don't hold you up for protection money, shall we say, where are you going to call, who are you going to call? And I'm sorry, lots of film references, but it's almost certainly going to be a mid-tier miner like Alamos, whether or not the management want to sell, and it wouldn't happen unless they wanted to sell, but it's an obvious target, and if not, you've got growth all the way for the next few years from the Argonaut deal.